All right. Today is Wednesday, April 20. Happy 420. Also known as, how should I say this without exciting the YouTube robot police? What? What's he saying now? Happy Relaxation Day. How about that? Hope everybody's getting higher tonight, but you know who's not getting higher? It is Netflix. Ooh, what a world of pain. We thought down 25% was bad. Today, the name was down over 35% in a single day. But rest assured, don't sell your shares, don't cancel your membership, and stop sharing your password with your mistress. You know why? Because we have an upcoming excellent documentary. You don't want to cancel your membership before you see that, or you can watch it as it happens by trading the stock market. But the real concern right now in the street is, are we past the growth era, the growth at any cost, the easy money era, pump it higher and higher and higher? Who cares about profits? Profits don't matter. Profits are for losers. Are we past that era, the growth era? And what will be the ramifications for the equities market if we are indeed past the growth era? This is exactly what we're going to talk about in tonight's program. Without further ado, here it is, in focus tonight. The growth scare, is it over? And what will the damages in the equities market look like? We now have another one. We heard from Deutsche Bank using the R word once again, the recession word, and then we saw Bank of America jumping on the bandwagon, followed by Goldman Sachs. And now we got another one. Citibank is also using the R word and saying what the rising probability of the growth scare means for the stock market according to Citigroup. What are they talking about? Recession worries are working their way into equities according to Citigroup. A mild recession in 2023 could lead to a drop of about 20% for the S&P 500 index from its late March high of around 4,600. This is according to analysts at Citigroup. Now, notice this. They say the equities market will go down 20% under the mild recession scenario. What do you think will happen if we have a not so mild recession? Well, here it is. Under a more severe macro growth scare, the index could see a drawdown of around 30% as the Federal Reserve continues to tighten its monetary policy in an already weakening economy in order to stave off persistently high inflation. And if Citigroup says it's going to be 30% to the downside, make that about 50%. And we're already seeing the growth, shall we say, stagnation already happening. Growth is no longer hot. Growth is no longer happening in this economy, with very few exceptions, as I'm about to show you when we talk about earnings reports. But look at this. In blue, the ETF for value. In orange, the ETF for growth. As you can see, year to date, both of them are down, but value is still outperforming growth. When we zoom out a little more, and let's go back to 2021, for example, the IWN value is up about 22.5%. Growth, on the other hand, is down about 13.5% since 2021. It appears that we got a top at around March 2021, when we started talking about the rotation to value investing in this channel, for example. But what if we have legitimate growth stagnation in the stock market besides Netflix? Because it's not going to be the only one. If the macro outlook suggests that the tailwinds pushing growth higher for the last 10 plus years are now weakening, then the damage is not going to be limited to Netflix. It's going to be widespread. And perhaps what we got out of Netflix's earnings, but most importantly, the reaction from the stock, is a telltale of what happens when the mentality shifts from growth to value from an investor's standpoint, but also what happens from a company's standpoint when the company shifts from the growth phase to the maturity phase, from the market saturation phase to the stagnation phase. And somebody might look at the reaction from Netflix stock, down over 35% in a single day, and down now, 60% year to date, more than 60%? Is it an overreaction? Why is this happening? How could this happen? It's a simple answer. This happens when you have valuation metrics that are outdated. When you have a stock that is valued as a growth company, meanwhile, the company is actually no longer at the growth stage. It is now at the maturity stage, shifting from the market saturation phase to the stagnation phase, where they actually start to lose growth. Then these valuation metrics have to be adjusted down dramatically and fast. And this is how we get a reaction of a stock down over 35% 20% in a single day, losing billions and billions of dollars. And now you must ask the question, which companies in the stock market right now are also shifting from the growth to the maturity stage, from the market saturation to the stagnation phase, because they will get hurt too. And these reports we're about to get will tell us exactly that. When you have a company that is shifting from a growth to a maturity stage, from a strategy point of view, two important keywords must be understood. Number one, retention. Number two, innovation. Retention because you're losing growth. You're losing subscribers. In the case of Netflix, you need retention strategies. And we talked about that in details in yesterday's video. The content becomes important. Using the algorithms becomes really important. Using consumer data becomes really important. If you have a consumer sitting at home launching the Netflix app, for example, you got 2 minutes max for that consumer to watch something, to hit play on something and get engaged in the platform. Otherwise, you risk losing that consumer, that viewer, because they now have other choices. If they cannot find anything interesting in Netflix, they're going to switch to HBO Max and the many other streaming services available. Is Netflix utilizing their algorithms, their consumer data in reducing that time, that window of time when the consumer has to look for content? Not really. And the bigger problem is they might not really have the content to retain that consumer to begin with. Furthermore, they got another problem in the fact that their viewers are global. It is a diverse group with many different tastes and viewership habits. You need to segment these viewers. Which viewers are the most important to the company? What are their habits like? What kind of content they're looking for? And you deliver that exactly to them. And in this case, the sweet balance between quantity and quality is what's needed. Not just pumping content that has a superstar name that you can consume in an hour and a half, and then you're done. Innovation also becomes really important, attracting new groups of viewers and consumers. Let's talk about this channel, for example. And again, I do this part-time. I'm not really implementing any of these strategies. I get home, I do the content, I click publish, and that's that. There is no thinking here, at least not for now, until the channel starts to make some money, real money, and then we're going to talk. But take this channel as an example. What is the maximum growth outlook for this channel? Let's say if we can attract the majority of the viewers on YouTube who are attracted to financial news, macro news, but most importantly, the stock market. Now you can bring up channels that has personalities. They're not really financial channels. I'm not going to name names, but they're really personality channels. And they have hundreds of thousands of subscribers, hundreds of thousands of viewers, if not millions. But we're talking about stock market channels that produce content pretty much every single day for investors, for traders, for people looking for economic information. Let's say that the maximum daily viewership will be tapped out at around, let's say, 50, 60,000 viewers every single day. If you can do that every single day, you got one of the most successful channels on YouTube, financial channels, I should say. But then what happens? When you hit the ceiling of growth, what happens after that? You start to lose viewers. You settle down from 60,000 viewers every single night to perhaps 50, 45, and that's that. You got your viewers, your regulars, and the channel stagnates. There is no more growth. So your strategy has to shift to retention. How can I retain the viewers that I already have? How can I minimize the damage of viewers leaving? Retention strategies become really important. And in retention strategies, specifically in streaming, for example, or content creation, the consistency of content and developing viewership habits, routines, become really important in retaining your viewers. Engagement becomes really important. Are you engaging with the viewers or not? But then comes the other side, innovation. Innovation is another avenue for growth. How can you attract new viewers? By perhaps producing different kind of content, by branching out. And you see a lot of YouTubers, for example, starting new channels on top of their existing channels because the existing channel already hit the growth ceiling. And now they're doing innovation. They're branching out with new channels, different ideas, different audiences, etc., etc. Now, unfortunately for Netflix, they have bad management with no strategy at all. You got the founder, Reed Hastings, whose brightest idea is gaming and sports. You want to talk about a disaster? Here it is. And then you got Sarandis, who pretty much understands nothing about streaming. He comes from the old guard of Hollywood studios, who are only interested in the superstar names and getting into parties and popping champagnes and mingling together. And that doesn't work in streaming. It's a war. You're not the only player anymore. You got competition now. You gotta shift strategies. And what is the brightest idea for Netflix right now? Ads. Give me all the face palms that you can find in the world, because really, ads? They're gonna create a new tier of membership, free with ads. Are you kidding me? You want to talk about cannibalization? You want to talk about destroying the platform with stupid ads? Now you have the advertisers having power over your content, and you have to censor and you have to cater to their tastes and preferences, and that ruins the experience for the viewer. Not a good move by the company. On top of that, the company got rid of the most avid binge watchers on the planet, the Russian viewer. They got rid of them. The company got out of Russia. You think that will come with no damage at all? What was the reason behind pulling out of Russia? What achievement, what impact did Netflix have by pulling out of Russia? Nothing, zero. They only destroyed their own company. And this is a lesson for all corporations, not to listen to the woke mob, the sheepies on Twitter and Facebook and the likes. They do not exist in real life. You just keep barking online. That's all there is. Hashtag boycott McDonald's. Why? Because McDonald's has operations in Russia. And then they pushed McDonald's to get out of Russia. If I'm the CEO of the company, I say, sorry, folks, hey, we're not involved in politics here. I got customers in Russia, and I'm going to continue to serve my customers. I got nothing to do with the politics or the leadership of the company. And most of these whiny bitches, anyways, will not boycott McDonald's or Netflix or anything. They're paid trolls online. That's all there is. But this is a legitimate wake-up call to the so-called growth companies like Netflix, like Peloton, like Amazon. They're moving to the maturity stage. Their growth is stagnating. They're losing growth. And some of these companies will fail entirely. We're talking about Peloton, of course. But it is also a wake-up call to the number one growth company on the planet right now, Tesla. Now, as you will see when we talk about the earnings report out of that company, the growth remains intact in Tesla, but the market looks forward. And when we look forward, are we about to see the end of market saturation by that company and the beginning of stagnation, for example? Are we about to see the company moving from the growth stage to the maturity stage, becoming a cash cow, for example? And what will the implications be on the stock? Because the company's not a problem. The company's doing fine. The stock is way overvalued. The stock is pricing in that the growth of the company will last for decades. What if that's not the case? What will happen to the stock? Is it also going to go down 20, 30, 50%? That is a massive loss of wealth, not just for the individual investors involved, but for the entirety of the stock market. And even Michael Burry issued a similar warning, explaining exactly what I just said. We saw in Netflix, the stock of the decade, by the way, the 2010s, the best performing stock of the 2010s, Netflix. Will it now hit a wall? Will Tesla also hit a wall? Will other companies also hit a wall? This is exactly what we have to keep our eyes open to. When we talk about the earnings that we got today, we got Procter & Gamble, for example, in the morning. Let's talk about these companies, not all of them. We're just going to talk about Procter & Gamble, Alcoa, and Tesla, the three most important earnings that we got today. But before we talk about the earnings from today, yesterday we got IBM, a value company, and the stock responded positively to the earnings, up over 7% today. And this is just an illustration for you that the mentality is shifting from growth to value. We're not saying that IBM is a great company, but it's being appreciated more right now than the so-called growth companies. But here it is. In the morning, we got Procter & Gamble, and the company posted its biggest sales in decades, but they also issued warnings about inflation. This is an inflation-proof company, at least for now. It performs really good under inflation, stagflation, even a recessionary environment, because it is a consumer staple company. The consumer has to spend and buy products from Procter & Gamble. So they got the pricing power. The question is, for how much longer? Let's read what the company said in the report today. And this is telling, by the way. Net sales in the third quarter of fiscal 2022 were $19.4 billion, a 7% increase versus the prior year. Listen to this. Organic sales, which exclude the impacts of foreign exchange, acquisitions, and divestitures, increased 10%. The organic sales increase was driven by 3% increase in shipment volumes, and listen to this, 5% from increased pricing, and 2% increase from positive geographic and product mix. So the majority of the increase in sales came from pricing power. They're hiking prices higher. Whether that's price gouging or passing the extra cost of inflation that they're incurring down to the end consumer, that's a different story. The end result remains the same. More and more and more inflation in the pipeline. Look at the results of this company, because they look good for now, and the stock will continue to hold, by the way, but they're gonna hit a wall really soon. The net sales were up 7% year over year. The cost of products sold was up 16% year over year. This is an alarming sign. The costs are rising significantly faster than net sales. But here is the good part. The company is also managing their expenses brilliantly, I must say, because look at these selling, general, and administrative expenses. They were down 7% year over year, and that helped the company to eke a positive net earnings of 4%. The question is, how long can they maintain this positive outcome? How long will the company enjoy the pricing power? Are we getting closer to seeing a negative net earnings reading from P&G in the next quarter? Perhaps. It will all depend on the demand destruction by the Fed. By demand destruction, we mean tightening the monetary policy. We will see job losses. We will see the equities market down. How will that impact Procter & Gamble? The answer is easy. The stock is trading pretty much closer to all-time highs. So it will go down, but it's going to still outperform growth stocks and many other stocks because it is a consumer staple company with an excellent dividend yield. So this will hold a lot better than many other companies. Now let's look at the different segments of this company, and we're looking at the sales and net earnings growth year over year. For the beauty segment, net sales were up 2% year over year. Net earnings were up even more, 12% year over year. Now, how could your net earnings growth exceed your revenue growth year over year? The explanation is easy. Look at the net sales drivers in the next table, for example. For beauty, the organic volume was actually down 1%. So they're selling less, but they're increasing prices so much, and the consumer remains receptive for now. The consumer is actually paying for these products because the increase in prices the beauty segment went higher by 4%. So you have, all in all, the net sales up 2% year over year, but the organic volume is down 1%. The foreign exchange impact is down 2%. Yet when you have the pricing impact up 4%, the end result is net sales are up 2%, almost 2%. You see how the pricing power works under inflation? And the same goes, by the way, for different segments of this business. For example, you look at grooming, the organic volume was 1%. The foreign exchange impact was a minus 5%, but the pricing power, the pricing impact was up by 6% year over year. And hence we have positive revenue growth year over year from the grooming segment, but most importantly, positive net earnings growth year over year. The problem is, I think that the pricing power for Procter & Gamble is peaking. Give it another quarter or two, and they're not going to be able to maintain this pricing power. I mean, you jack up prices 6% year over year for grooming. Can you do that? Can you continue to do that? Quarter over quarter, year over year. We got earnings, for example, from Albertsons, and this is the beauty of earnings season. Albertsons says the consumer is shifting their spending behavior because of inflation. Because they have to pay more at the gas pump, they're buying less at the store. So at some point, the consumer is going to pay more at the pump. They're not going to spend more and pay the extra inflation price for grooming products from Procter & Gamble. This is an important point you got to keep in mind. Next, let's talk about Alcoa because this will give us a global picture of inflation and the pricing power, most importantly, the health of economies across the globe, specifically China. Now, there is a dark cloud hovering above Alcoa, and this cloud is getting out of the Russian market entirely. It's going to hurt the company, no doubt about it, but for now, this company is more able to withstand any losses from Russia a lot better because it's a different company entirely. They have the pricing power. When we look at the EBITDA for the company, for example, quarter over quarter, it is up dramatically. But what were the drivers of this increase in EBITDA quarter over quarter? It certainly wasn't the currency impact. The currency impact had a negative 19 on EBITDA. Likewise, it wasn't raw materials. They're paying more for that. It wasn't energy prices. They have to pay more to transport the aluminum. It was, number one, the pricing power, the price mix, the metals prices. They can pass that to the end consumer. The surge in aluminum prices, aluminum futures, helped the company to withstand the storm. All of the negative impacts, be it currency exchange rates or otherwise, because they continue to have the pricing power. Aluminum prices are moving higher, and the consumer, for now, remains receptive. Look at these earnings, by the way. They're pristine, at least for now. The sales were up 14.7% year over year. Expenses were down 1% year over year. So on top of the growth in revenues, the company is also managing their expenses brilliantly. All in all, the net income year over year was up a stunning 152.5% year over year. Now, I own the stock in my portfolio. I see it's down after hours, not by a lot, but you got to keep in mind the stock is up big year to date. So it deserves a pullback. And for now, you look at these earnings, a year over year increase in net income by over 150%. This is the kind of stock where you want to buy the dip. Look at the charts, look at the technicals, look at the support lines, and make your decisions accordingly. You don't want to buy the dip in a company that's already bruised and, more importantly, losing its competitive advantage. You want to buy the dip in companies where the tailwinds remain intact. The macro tailwinds, the fundamental tailwinds, the technical tailwinds, because buying the dip in these companies will be rewarding. And lastly, what about Tesla? One of the most important names, specifically for the retail investors crowd, for the growth in the economy, the demand in the economy. And we talked about Tesla numerous times before, that they continue to have the pricing power. They continue to withstand the inflation cost because Tesla consumers are willing to pay whatever increases they're going to incur. If they increase the prices from $50,000 to $60,000, $65,000, $70,000, they're still going to buy the car for two important reasons. Number one, the branding of Tesla produces a cult following, and the culties are going to pay whatever price you charge them. Doesn't matter. Number two, Tesla consumers are not looking for the resale value. When I buy a Subaru, a Toyota, a Honda, whatever car it is, I'm keeping in mind the resale value. So I'm not buying now at these insane prices because what if the economy sours next year or so? Am I going to be able to sell this car at a profit, or will the resale value drop down dramatically, making me look like a fool who bought at the top? For Tesla drivers, Tesla owners, that doesn't matter. They see themselves as owning the car forever. It is a valuable position to them. It is part of their personality, so they don't care about the resale value. And this is important. The psychology is important in the consumer behavior when it comes to this company. Now, unlike Netflix, for example, the growth in this company remains intact in a big way, and you're not going to see the stock dropping down until the growth story of this company is negated. And this report doesn't produce that. At some point, we will see a report where the demand is slowing down, where Tesla's ability to pass the inflation cost diminishes, and the increased competition in Chinese markets, in European markets, in North American markets will start to chip away at Tesla's market share. And we will see Tesla moving from the growth stage to the maturity stage, to the cash cow stage, from the market saturation, which is the company is in right now, to stagnation, where consumer retention becomes really important. But the company is not there yet, and therefore we see the stock still holding, even though it is extremely overvalued. But at some point, when the growth story is negated, what we saw in Netflix stock will be repeated in this company. But for now, look at these numbers. Let's do the quarter over quarter numbers, because the year over year numbers for a growth company becomes immaterial, really. You have massive growth year over year. This is not a surprise for this company. But the quarter over quarter numbers are important, even though the automotive business is seasonal, but not for this growth company. Tesla consumers are going to buy the car when they want to buy the car. There is no seasonality from the consumer behavior perspective. So the automotive revenues alone were up 5.6% quarter over quarter. The regulatory credits, which Tesla been criticized for many years, that hey, the numbers are being bloated by the regulatory credit. Well, that was up about 116% quarter over quarter. But it's no longer the main driver of revenue in this company. The company is making legitimate revenue at this point. When we talk about the operating expenses, and this is really baffling, I need to dig down and look at the numbers even more. If Tesla provides that, unfortunately, they don't, but the operating expenses went down quarter over quarter by 16, almost 17%. That is stunning, which is producing a net income of over 43% quarter over quarter. Now, last quarter, we were baffled by the increase in operating expenses quarter over quarter and year over year specifically by over 50%. Well, we now know that the last quarter was an outlier where Tesla incurred more operating expenses, but they appear to have fixed that for now. Again, I say these numbers are baffling because they dropped from $2.2 billion in the fourth quarter of last year to $1.8 billion last quarter this year. So I have to look at the earnings call and what really drove the expenses down quarter over quarter. That requires more investigation. But perhaps the only alarming sign that I can find in this report is the Model 3/Y production. Unfortunately, Tesla doesn't really segment the production by each model. Model 3 on its own, they kind of lump it together, 3 and Y, the S and X. But of course, the crown jewel of the company is the Model 3. Well, the quarter over quarter production numbers went down by 1,542 units, and the deliveries numbers went down by 1,560 units. Could this be due to the impact of the lockdowns in the Shanghai factory? Perhaps, because for now, there is no sign at all that we have demand destruction in Tesla. I don't think we have a demand problem yet from Tesla consumers. Maybe when the economy sours, maybe when the Fed becomes a little more aggressive, we will see demand destruction in Tesla. And this is an important point. When you look at this report, if you're Jerome Powell, for example, if you're the Fed, you're not seeing any demand destruction in the economy. And Tesla's earnings is a proof of that. The demand remains white hot. It requires aggressive Fed policy to cool down that demand. Otherwise, inflation will continue to move higher and higher and higher. And the average selling price for this company will continue to move higher and higher and higher. So this report is important from a monetary perspective. When they talk about the demand destruction, or the demand is down, when Bullard says the demand is down already and the market is doing the Fed's work for it, bullshit. Look at this report. Look at Procter & Gamble. The demand is still here and it continues to move higher because the Fed remains way behind the curve. But the moral of the story here is we have one company, Netflix, which we now know for sure moved from the growth stage to the maturity stage. And you're seeing the impact on the stock right before your eyes, down 35% plus in a single day. The same thing will happen to a stock like Tesla, which is right now priced as a hyper-growth company. What will happen when the company moves from growth to maturity? The stock will go down in a big way, and the increased competitive environment is a driver of a company moving from the growth stage to the maturity stage. We saw exactly that in Netflix when the competition started to pop up from HBO Max, Disney Plus, etc., etc. That accelerated the move of the company from growth to maturity. What we're seeing right now in Tesla, for example, the growth is ramping up from European competitors, from Chinese competitors, from US competitors, and sooner or later, this will push Tesla from growth to maturity. And it's not just Netflix and Tesla. We're talking about many companies in the stock market. So you got to keep that in mind when you look at stocks and decide to invest in them. Where is the company? Is it in growth, maturity? What are the surrounding factors? The macroeconomics factors, the competitive environment factors, and many others. We can talk more about that, but I got limited time here, so I got to move on to the market coverage, and we start with the performance of indices today. And here we go. The Dow Industrial Average was in the green, 249.59 points, or a gain of 0.71%. The Nasdaq, on the other hand, was down 166.59 points, or a decline of 1.22%. The S&P is kind of between the Dow and the Nasdaq, and it was pretty much flattish, down 2.76 points, or a decline of 0.06%. Here are the sector's performances today. Leading the pack at number 1, capturing the gold medal, REITs. And at number 2 for the silver, defensives. Number 3 for the bronze, healthcare. The laggards of the day were led by communication services. No wonder why. You got Netflix down, you got Facebook down big, and then we have consumer cyclicals also lagging for the day, along with technology. The advance to decline ratios, NYSE 63% advancing versus 34% declining. The Nasdaq 46% advancing versus 49% declining. Commodities, what's going on here? We talk about energy commodities, for example. Crude oil was stable, pretty much flattish. The WTI closed positive, while Brent closed to the downside, be it muted action both ways. Gasoline was higher by a little over 1%, while heating oil surged higher by almost 2.5% today. Natural gas, on the other hand, was down another 5% or so. It appears that the squeeze in natural gas prices are over, but soon enough, the dip will be bought again because the fundamentals remain intact. And if you're bullish nat gas, you actually want the squeeze to be over because you want natural gas to go higher, not because of a mechanical squeeze, but because of the fundamentals. And there are plenty of fundamentals supporting higher natural gas prices. When we talk about crude and energy in particular, we got data today from China, and it appears that Chinese imports of crude are down across the board in the month of March, down 13% from from Saudi, down 14% from Russia. And now we have to play the game of what was the reason behind that. Was it because the Chinese authorities enforced a draconian lockdown that caused the demand on crude to cool down? Or was it due to the fact that the Chinese are actually buying cheap Russian oil in the black market? Think about that. But back to commodities, when we talk about softs, massive surge for lumber, almost at 1,000 again, up over 6%. Likewise, cocoa was up a little under 1%. Cotton, sugar were pretty much in the flat line, while we got declines led by coffee and OJ, both are down a little over 1%. What about metals? Muted for gold, silver, platinum, while we have modest declines for copper, a little over 1%, and a massive gain for palladium once again, scoring about 3% today. When we talk about meats, unfortunately, the new big tech is getting slaughtered. Lean hogs is down a little over 2%, while live and feeder cattle futures moving higher and scoring gains of over 1%. Grains, what's going on here? Rough rice, back on track again, gaining a little over 2%. Likewise, we have gains for wheat, corn, soybean meal, but be it modest gains. On the other hand, soybeans and canola futures were muted. On the other hand, oats and soybean oil were down big. Oats down over 3%, soybean oil down almost 2%. Moving on to options, the big casino. Are we seeing the options volume ramping up again? Not really. The volume remains dead, like Zed. Regardless, Tesla was at number one, the souffle, with around 800,000 contracts traded for the name today. About 50% of those were calls. Netflix, at number two, at around 800,000 contracts. About 42% of those were calls. What's really amazing is the stock is down over 60% year to date, and it is down 35% plus in a single day. But I've seen a lot of put options buying on Netflix today, betting for more declines to come. How bad is it gonna get for this name? But here it is, at number three, Apple at around 750,000 contracts traded today. About 57% of those were calls. AMC, look at the volume, down big, and therefore the rebound is pretty much over for AMC. What about the unusual activities that took place in the options market today? We start with the ticker VST for Vestra, a winner year to date. This is a utility company, so they're obviously benefiting year to date from the increase in energy prices. They can pass that into the consumer. Somebody sees more gains to come for the name by buying the 28 calls for the expiration date, June 17th, with expectations that the name could move higher by more than 6.5% by then. They paid around $1 a piece to enter this trade, all in all spending around $2 million. What about the ticker IBM? IBM is moving higher after earnings. We've been waiting for the promises of Krishna to deliver growth for IBM finally, after years of stagnation. Is he delivering growth? I looked at the earnings report. I'm not that impressed, by the way. We have yet to see the growth factor in the acquisition of Red Hat. But the good news for IBM is the impact from the Russia exit is minimal, at least for now. And the revenues, the profits remain intact. The company's producing a lot of cash, and investors are liking cash in this market environment. So they're buying more calls. They're buying the 150 calls with the expiration date July 15th, with expectations that IBM could move higher by more than 8.5% by then. They paid around $1.25 a piece to enter this trade, all in all spending around $2.5 million. What about the ticker CSX Railroads? I believe the name reported after the bell. I think it's up. But this is an important earnings report for the upcoming UNP earnings, Union Pacific. This is the one I'm watching, but I'm going to have to look at CSX's earnings after I'm done recording this show. But somebody bought calls today, perhaps the right call, the 38 calls for the expiration date, May 20th, with the expectations that the name could move higher by more than 7.5% by then. They paid around 45 cents a piece to enter this trade, all in all spending around $950,000. What about the ticker F for Ford? I got some news for Ford. We'll talk in the heat map analysis, but the name is down big year to date. I'm a shareholder of Ford, not happy with the performance year to date, but perhaps the tides are about to turn, at least according to this trade, because somebody's buying the 17 calls for the expiration date, May 27th, with expectations that Ford could move higher by more than 6% by then. They paid around 55 cents a piece to enter this trade, all in all spending around $1 million. We have a lot of trades for the ticker NFLX Netflix. We'll cover two of those. One is a call spread with the expiration date of this upcoming Friday, April 22nd. So they're betting for a rebound. The name is down big. They're just bidding for a rebound of about 6% plus, but not more than 10% by Friday. They bought the 240 calls and they sold the 250 calls. They received about $1 a piece from selling the 250. They paid around $2 a piece for buying the 240. All in all, the entry cost is down to $1 a piece, bringing the total to about $1.5 million for this trade. And again, the put trade that you see below, they bought the 200 puts for the expiration date April 29th, meaning if these traders are correct, we could see a rebound, let's say by Friday, for Netflix, and then the pain resumes the very next week. In this case, they're expecting the name to go down by more than 11.5% by then, and they paid around $2.70 a piece to enter this trade, all in all spending around $2 million. Moving on to the heat map analysis, what do we see here? A lot of pain in the growth segments in the stock market. We're talking about the communication services, anything from Facebook to Snapchat to DoorDash to Spotify. Anything related to streaming and memberships was down big. Look at Disney down big. Even Comcast, the legacy ones, were down. Roblox was down. So the impact from the implosion of Netflix was felt across the market today. Facebook down big. Tesla was down big. Amazon down big. The software names down big, Shopify down over 13% today alone. Think about that. PayPal in financials was down over 8% today. So there was fear or a little bit of a panic looking at Netflix today, and it was contagious across the equities market. Yet we have other corners that are still working. One of these corners is consumer staples. Look at Procter & Gamble, PG, up over 2.5%, Coca-Cola, Mondelez, Hershey's, Budweiser, ADM, Walmart, Costco. All of these names continue to outperform. In energy, we have natural gas names, likes of Coterra, EOG, that managed to outperform today. Likewise, REITs continue to outperform, utilities continue to outperform, industrials, but you got to be selective in industrials. When it comes to healthcare, we got a rebound of Abbott Laboratories earnings. The ticker ABT was up over 2% today. When we dig down in technology, the impact of IBM's earnings, IBM was up over 7%. So the legacy technology were also up. We're talking about names like Cisco, Nokia, Ericsson, ASML, Dell. All of these names were trading higher today on the heels of IBM's earnings. So boring is good in this case. When we talk about banks are still outperforming. Earnings are out of the way. The yield curve is steepening again. So far, so good for financials. And we're sticking with the regionals, of course. When we talk about consumer cyclicals, for example, the recent rally that we saw in hotels, casinos, apparel names, restaurants, is kind of cooling down for now. When we look at the automotives, the value names, Toyota and Honda, outperforming. The ticker HMC Honda was up over 2% today. So all in all, the theme was stick with value and get rid of growth. Now, Tesla's earnings after the bell will change that mentality, at least for tomorrow's activities. So we could see buying of the dip in these losers today. Look at names like Shopify, for example, down over 13%. If we get a rebound tomorrow, this name will surge higher. It will erase at least 3, 4, 5% worth of losses. Let's talk about some news, corporate news here. We start with the ticker F. Ford, and this is, by the way, comes on the heels of Tesla's earnings. Tesla has a supply problem. The factory shutdowns, the material shortages. This is the problem for Tesla, the souffle. It's not the demand. The demand is white hot, and the demand remains hot for Ford. A lot of orders for the Mach-E, to the point where Ford had to shut down orders for the 2022 Mach-E due to overwhelming demand. So again, Ford is facing the same problem of Tesla. High demand, but the supply is nowhere to be found. Yet the market is giving a generous premium for Tesla, not for Ford. So could this be the beginning of the rebound in Ford? I certainly think so. It will be confirmed by the earnings report when we get it from this company. We also got bad news from the biggest stock, the big kahuna in the market, Apple. And this is bad news for the entirety of the economy. Why? Because wage inflation continues to move higher, which will cause the Fed to act more aggressively. We now have news that it's not just Starbucks, by the way, which the company is fighting the unions. They're accusing the unions of intimidating workers. Amazon is now using their political power to turn the election results in Staten Island. They want to intimidate the unions. They want to talk about intimidation. Talk about the companies intimidating their workers, spying on their phones and social media, and monitoring them with cameras and sensors, encouraging workers to rat on other workers who are interested in unionization. Anyhow, We got the news that Apple retail workers in Atlanta are filing for a union election, and this will be contagious. It's not going to be limited to Atlanta. It's going to be in New York and LA and many other Apple stores. Moving on to the heat map for the ETFs, green across the board with exceptions. Anything technology was down, but specifically for the high multiple names, and therefore you're not seeing a lot of pain in the ETFs. Look at the XLK, for example, was barely down. The SOXX, the SMH for chips, barely down. Yet the TQQQs was down big, over 4.5%, and I continue to advise all of the retail investors and traders watching this program, if you're going to buy the dip in the Qs, buy the actual Qs. If you're going to invest, buy the actual Qs. For the love of God, don't buy the TQQQs. You can trade it, but don't add it to your portfolio. Not a good move. The winners were led by REITs, the IYR, Energy, the XOP, was up, the XLV for healthcare, the XLP for consumer staples on the heels of Procter & Gamble. We also have banks, the KRE continues to outperform along with the XLF. And it was indeed a value kind of day, the VTV, IWD in the green outperforming the IWF and the VUG. Not a good day for the VIX proxies though. They're all down. So what does that mean? Even though Netflix earnings were a disaster, perhaps the biggest disaster is the stock reaction, but it's not fading away the confidence, or shall we say the arrogance in the stock market. Nobody's buying puts right now. Nobody's hedging. When it comes to international markets, it was a muted day, mostly in the green, but we have modest declines for developing markets. For example, the EEM was down about 0.5 percentage point or so, but the majority of the declines came from Chinese ETFs. The FXY, MCHY down big. When we talk about commodities, solar is down big, the ticker TAN. Likewise, natural gas was down, the ticker UNG and the ticker BOIL, but we have a rebound in uranium. URA was up big today. Along, when we talk about fixed income, the TLT finally is moving higher, and it gained about 2% today. Let's talk charts now. We start with the S&P 500, the SPY 30 minutes chart. We got the bull flag yesterday. The bull flag is playing out, although the SPY faced some resistance at around 446.5. We have a slight negative divergence on the RSI. Perhaps it means at least overnight, the futures could go down or retest 443 and then bounce higher again. But all in all, in the grand scheme of things, the SPY satisfied two important conditions for me to go along. Number one, it reversed the negative sloping line of resistance. It is now trading above that. Number two, it made a higher low for now, and it continues to hold on to that higher low. My sentiment will change if the chart loses 443 for the day, and it closes below that number on the day. Then we're talking about a false breakout, a bull trap, and we're going down to at least 438. But absent of that, the bulls have the advantage in this chart. What about the S&P 500, the continuous contract for the daily chart? Again, a rebound of 4,384.5. This is point number one for the bulls. Point number two, they almost got 4,472 as support today. Number three, the volume is moving higher on the buying side. Number four, the momentum indicators are curling their way higher in an attempt to reverse the negative divergences in both the RSI and the MACD indicators. And what do the bears have in this chart? The answer is nothing, at least for now, nothing. You got to see 4,384.5 being violated as support once again. That would trigger a shorting trade. But for now, the bulls remain in charge in the SPY. A different story for the Qs, the NASDAQ. This is a 30 minutes chart, which faced resistance at around 347 once again. And it pulled down, losing 343 as support. It could not make it above that number. The good news is it continues to hold on at 341. It did not lose 341. Had it lost 341 for good, we would have said abandon. We're going down to 334 once again. Now, was the optimism restored by Tesla's earnings? I certainly think so, to a degree at least, to make the argument as the following. Netflix's earnings was due to Netflix missteps. The management made a lot of missteps. That's Netflix's problem. It is not a problem for the rest of the market. Look at Tesla's earnings, for example, and this could be the dominating thought in tomorrow's activities, and we could see the Qs moving higher and recapturing 343 as support. And if that happens, we will look again at 347 as resistance. What about the daily chart for the Qs, the continuous contract? The good news for the bulls is 14,000 as support remains intact. The moment you lose 14,000, grab the diapers, panic, do whatever you need to do. But for now, the hope remains alive. We're not seeing dramatic improvement. In the momentum indicators, for example, the volume is moving higher on a down day, so for this chart, for the Qs, the bears still have a slim advantage here. What about the IWM, small caps, from a 30 minutes perspective? Again, we got the bull flag formation. The chart has been battling 201.68 as resistance over and over and over again. On the other hand, it has been keeping support at 196.5 over and over and over and over again. Now we have an answer. The chart moved higher above 201.68, so this is a massive win for the IWM bulls, but it kind of stalled today. It weakened by the end of the day, matter of fact. And now we have a negative divergence on the RSI, meaning if we go down, test number one will be 201.68. If that fails, it's going to be a really bad sign. But if we see the futures firming up overnight, then the next destination will be 204.5. And if the bulls recapture that, it will be a massive win because now you have two solid supports that have been tested over and over and over again. 201.68, a 196.5. So you're not going to get caught off guard if the IWM turns sour. If it climbs above 204.5 and you buy, and then all of a sudden it flushes down, you know you got solid support beneath. The Dixie, the dollar index, what's going on here? Is it topping? We've seen this movie before. Only for Tricky Dixie to come back and smack us right in the mouth, Will Smith style, and say, not so fast. So we're not going to call it the top until the chart loses 99.9 as support. Until we see a dramatic pullback in the momentum indicators, the RSI, and the MACD. And here it is, gold. Gold remains stable. And if the dollar is about to top, it will be good news for gold. Gold will move higher. Now, the gold bugs are speculating that this is a cup and handle formation, at least the beginning stages of a cup and handle formation. It is too early to say. Let's take it one day at a time. So long as the support of 1,925 remains intact, so far, so good. What about oil? UK oil, this is for Brent, a 4 hours chart. We got a formation of a bear flag. The chart flushed down, losing the support of 105.84 before bouncing higher again. This is an important sign. Now, can crude move higher from this point on? Because we got a reaction. The moment the chart lost 105.84, the buyers showed up right away to defend the chart and keep it above 105.84, which means we have support here. We got the strength, but can the chart move higher from this point on after the pump? Because if it fails again, 105.84, we're going to see a flush down all the way to 100. Here's our daily chart for the 10-year yield. Again, is it topping? We've seen this movie before. We called it a top and it didn't happen. We need a confirmation, and a confirmation will not happen until we have a really bad day in the 10-year yield. A big red candle that erases a few days worth of gains, and so far we don't have any of that. Moving on to the TLT, a weekly chart, what do we see here? A big rebound on higher volume, which has the characteristics of a bottom. The chart is extremely oversold. Could it be the bottom for now? It looks bottom-ish, yet we cannot confirm that until we see the 10-year yield experiencing a big down day, erasing a few days worth of gains. And look at this, by the way. This is from Tavi Costa. This is the biggest loss year-over-year change for the TLT in history. Furthermore, the RSI indicator was also at the lows on record, so the TLT got way oversold, and then we got the rebound. Of course, the confirmation need not to be technical in nature. It would be even more powerful if it happens based on fundamentals. For example, any Fed news, any macro news, that would be even better than the technical rebound. What about the VIX? A 4 hours chart. It is flirting with 20, the most important support. You close below 20 and you got a massive win for market bulls. So the bears got to keep 20 as support. For now, the MACD indicator is in negative divergence, showing red impressions on the histogram. Likewise, the RSI remains in negative divergence. In all likelihood, if things remain as is, we will see 20 being violated as support. The question is, will the bears make a comeback and defend 20 as support? That remains to be seen. And here's the VXN, a 4 hours chart, the VIX for the NASDAQ. Unlike the actual VIX, we have positive momentum on the MACD indicator, although it's getting a little weaker. It's cooling off here, kind of leveling off, yet we're seeing the chart showing higher lows, and it is keeping 27.5. Now, this becomes a battle of psychology for now. If the market decides to go with Tesla rather than Netflix, then we will see the VXN moving down and violating 27.5 as support. The question remains, will the bears defend 27.5 by the end of the week? Here's the daily chart of Apple. It moved higher today, but it did not make it above the upper edge of the channel, which remains as resistance for now. And it appears that we got a rejection from that line. We have yet to confirm the rejection. You got to see another down day to confirm it. But for now, when you look at the momentum indicators, they're kind of firming up. So we're not going to call it a rejection for now, because what if the RSI and the MACD indicators reverse the negative divergence and we see the chart trading above the upper edge of the channel once again? Then we're going to look at 172.4 as the next resistance. And here it is, Tesla, an hourly chart. What's going on here? It remains within a range. It cannot make it above 1,025. It cannot break above that resistance, and it continues to go back and forth, back and forth. The support is 995. That is lost now, although after hours, Tesla made up for that. Yet it continues to stall even after hours at around 1,025. So this will be the most important chart to watch right off the gate. If we have a gap up in the morning, for example, and then the chart gets rejected once again from 1,025, it's going to be a bad sign for Tesla, but not just Tesla, also the rest of the Nasdaq. If the chart makes it above 1,025 and we see more buying, more call options buying, for example, a lot of short covering right off the gate because a lot of people bought puts and shorted the name ahead of the report. If we see that kind of buying with high volume and the chart makes it above 1,025, then we will see a positive day in the Nasdaq. So watch out for Tesla in the morning. And here it is, Bitcoin, tulips, what's going on here? No update, still facing the resistance of 42,000. Could Tesla do the magic here and switch us to risk on once again? If that happens, Bitcoin will move higher and break above 42,000. If not, we will see a rejection and Bitcoin is going down to 35,750. And lastly, AMC. We're talking about risk on and risk off, and whether the market is going to believe Tesla or Netflix. Even if the market chooses Tesla's side of the story and chooses to go with risk on, does that mean that AMC will move higher? Perhaps. But look at the MACD indicator, for example. It appears the recent rebound is kind of topping. It's kind of cooling down. We're not seeing a lot of energy here in the buying. No options buying, no call options buying, no organic buying by the apes. We saw some short covering and we're waiting for more. But if the apes don't initiate the buying, then they're not going to spark a reaction by the shorts to cover. Somebody going to buy first. Somebody going to buy a lot, specifically call options out of the money to elicit that reaction higher. Otherwise, the stock is going to go down to the support of 14,024. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the initial jobless claims. We have the Philly manufacturing survey. We have leading economic indicators. We also have Bullard, Mr. Bullard from the St. Louis Fed. Can he take us higher again? But most importantly, we have the big dog, Chairman Powell, speaking in the IMF. His views on the global economy will be really important and impactful to the stock market. What about earnings? What do we have on the deck tomorrow? We have AT&T, we have Freeport-McMoRan, we have American Airlines, Blackstone, Philip Morris, and Snapchat. With that, folks, I'm done here. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.